Hello and welcome everyone to today's virtual coffee talk webinar. My name is Margaret. I will be your web host for today. We have a few housekeeping announcements and then I will introduce our speakers. As a reminder, in order to earn CPE credit for today's session, stay connected for the webcast for the entire program and participate by responding to at least 3 of the 4 interactive questions that will be presented on your screen. Second, there will be a course evaluation, which will open in a new window upon exiting the webcast at the end of the program. With that, I will introduce our speakers. First, we have Kevin Jacobs, a Managing Director with Alvarez Marsal Taxand in Washington, D.C., and the National Tax Office Practice Leader. He brings more than 15 years of experience in tax matters in both the public and private sector. Next, we have Neil Fletcher, a Managing Director with Alvarez Marsal Taxand in London. He specializes in M&A tax transactions. His primary areas of concentration are buyouts, carve-out transactions, and corporate joint ventures. Next, Nick Crama, a director with Alvarez Marsal Taxand in Amsterdam. He brings more than 10 years of experience in tax advisory in the investment management industry. Next, Walid Eljaafari is the co-founder of Algonomia, a company dedicated to the transformation of tax. His experience in mathematics and the law have made it clear to him how much the tech sector can benefit from the new technologies powered by algorithms and data science. Finally, as always, we have Kevin DeYoung, a Sales and Business Development Manager with Wolters Kluwer Tax and Accounting. He will be showing us today how to find additional answers and resources using CCH Answer Connect. Thank you. Now, Kevin, take it away.
Great, thanks. And thanks everyone for joining today. We have a full agenda, and I'm very excited by my co-panelists today. As you heard talking on the substantive content, I am the sole US person, and the reason for that is the US hasn't adopted Pillar 2. We are seeing great momentum abroad, and so what better way to give you an idea of what other countries are doing with regards to Pillar 2, and more importantly, what should US countries know about Pillar 2 than actually going straight to the source. So with that, we're going to focus first on what is Pillar 2, what to expect, looking at the transition over the past 2 years and the trajectory that I just sort of suggested. We'll talk briefly about comparing the US regime to what is in Pillar 2, what the end game is, the importance of data and how you can farm the data, and really just hopefully you'll take away from it, what should I know? And really there's a host of questions that still haven't been answered. The key thing to keep in mind, at least from my perspective, is 2 things. Recently, President Biden released his budget proposal. It proposed to adopt or move the US towards adopting Pillar 2. With that said, a key item to note is it also did not propose to remove the corporate alternative minimum tax. So if, let's just say by some miracle, the president's proposal is actually adopted, US companies would have not only Pillar 2 to contend with, they would also have the corporate alternative minimum tax. That in of itself is troubling and adds a great level of complexity in the United States. With that, we're going to launch our first polling question, and these questions shouldn't be that hard, which is Pillar 2 a priority item for your organization? Yes or no? Obviously, no right or wrong answers, but please make sure you answer it so that way you can qualify for CPE credit. With that said, while they're answering it, why don't we start talking about what Pillar 2 is? So with that, where are we? We can see, when you see the slides, you'll see, okay, it's a system of top-up taxes designed by the OECD to sort of make sure that everyone's paying 15% of tax. Great, but where are we? What should they expect? So I'll turn to my panelists. They're dealing with this much closer. What are some of the defining moments that you've seen over the past year, and what are we going to be discussing today?
Okay, I'm actually looking at a blue screen, but I'll continue. So my name is Neil Fletcher, and I'm a tax partner based in London for Alvarez Marsal. So one of the, maybe we just step back and say, you know, what is that pillar 2? Well, pillar 2 is the second pillar of the inclusive framework, which is in some people's language, BEPS 2.0. In other people's language, it's maybe taking forward some of the BEPS initiatives and even simplifying some of them, with pillar 1 being the digital tax, which is rather more controversial and not as well advanced as pillar 2. As Kevin kindly said in his introduction, pillar 2 is intended to be, in concept, a rather simple approach to a minimum tax globally set at the rate of 15% for all companies that are within its scope. So those companies which are with a turnover of 750 million euros, that of itself produces some complexity when looking at companies who do not operate in a euro environment. So there's a drop to think about, and it will be applied according to hopefully a consistent methodology around the world. In terms of its overall design, it doesn't look that different from a large part of the US tax code, more of which later. In terms of where we've got to, well, one of the motivations for pushing forward with pillar 2, certainly from the European end, and it would be fair to say that the momentum for pillar 2 has originated from the European continent, is very much around repairing the tax base, the corporate tax base, post the pandemic and earlier. So the whole idea is to raise additional corporate tax. The OECD have produced numbers and refined those numbers, and based on their metrics, they're looking to increase the global tax take on corporate tax by round about 8–9% from where it is today. So it's a sizable increase in the overall scope of corporate tax. In terms of that timeline, I mean, one of the most remarkable things is where on that timeline, when you go back to when the initial proposals were made back in 2019, which were largely started at the effective conclusion of the first 15 action points of BEPS 1.0. It's moved along at a fair clip with only really 1 year of delay, which of itself I think was not necessarily a predetermined outcome back in 2019 and 2020. So an awful lot of hard work has been done by an awful lot of people to move it to this point. In terms of where we're at now, well, where we're at now is not that different in meat and malt to where we were in that red box of 2021. The rules have been published. There's a huge amount of detail. There's been commentary published a year ago. A month ago, we had more administrative guidance, and things are moving on very rapidly towards national legislation being drafted. In fact, only this week, the German ministry published their draft legislation. The UK has their draft legislation. It's really live in terms of coming with legislation to the table. In terms of details, there's been an awful lot of backwards and forwards, but the reality is that very little has changed since that blueprint was published back in 2021. So where are we going to go from here? Well, if the past is anything like an indicator of the future performance, it does look like the straps are going to get pulled on the 1st of January 2022, when the first wave of the globe rules hits the decks with the income inclusion rule. And for those in the US, that's a a rule not dissimilar at all to the GILTI rule. And following from that, a year later, there'll be the sort of carrot and stick approach of what is called the UTPR, which is a little bit like the beat, but also fundamentally a very important development, which is that countries which have adopted the GLOBE rules will be actively probably introducing what are called qualified domestic top-up taxes. So that's designed to effectively raise the tax down at the individual jurisdiction level rather than having it floating up to a more parental level under the GILTI or IRR type model.
Yeah, and it's really helpful to hear that. And I think one of the key takeaways is on the bottom of the slide where you see this domestic differences. I mean, when I think about it, and I'm just the U.S. tax person, the way to think about these rules is when countries are adopting them, each country has the ability of adopting their own set of rules. And so it's equivalent to state taxation. So you might have this broad concept, but each country is sort of within this framework, but they get to make their own little tweaks and so forth. And so that adds a whole level of complexity, and we're going to talk about that in just a minute. The other thing to be mindful of, and it's really what Neil was just saying, is, well, if you have a multinational corporation, a group, and you are residing in one of the countries that adopts Pillar 2, at that point, in essence, you're subjecting, with certain exclusions, your earnings of the whole group to Pillar 2, even if none of the other jurisdictions adopt it. And so what happens is, once you're in one of those jurisdictions, the other jurisdictions say, look, you're paying this tax anyway, why don't you pay it to us instead? So it's really not saying we're raising taxes on you, we're just taking the tax revenue to our jurisdiction instead of letting you pay it to someone else. So those are sort of two key things to be mindful of. But I guess, Nick, can you tell us sort of what are we seeing in the market right now?
Yeah, well, I think things really picked up, of course, at the December last year when the European Union adopted the Pillar 2 directive. I think that turned it into a reality. Before that, there was still this sort of inherent uncertainty as to whether or not the rules were really going to be adopted by any of the jurisdictions. So I think that really got things moving. What we're really seeing in the market is, well, we're seeing different things, but I think the general trend is the larger the multinational enterprise is, the higher Pillar 2 is on their list of priority items. And I think that makes sense, right? I mean, you have multinationals that have a revenue of 750 million, but there are also multinationals that have a revenue that is a multiple or a large multiple of that number. And the larger they are, the more jurisdictions you'll be active and the more entities you're likely to have. So I think that also says something about the impending compliance burden that you have to deal with. So the bigger the multinational, the more advanced they are when it comes to Pillar 2. And to be very honest, if we look at our client base and the conversations that we're having, we're seeing a lot of different things. So even among the larger multinationals, there are some that are still, early stages, determining to what extent they're in scope, testing technology solutions, seeing how they want to move forward. And we also have clients that are light years ahead that are already making detailed ETR computations based on historical data and making forecasts for the future. So yes, seeing a lot of different things, but with that adoption by the European Union, things got real.
I mean, Nick, just to add to that, when we talk about our clients, of course, people are not starting from the same base. There's some very sophisticated tax jurisdictions and taxpayers, maybe continental Europe, maybe US, maybe other places. There are also places that are yet to adopt a corporate tax system that are jumping straight into Pillar 2. So Dubai, there's places that have barely touched the environment of what it is like to administer complicated taxes like corporate income tax, going straight to the heart of it. So they're on a completely different journey to somebody who may be sitting, in Munich or New York or Sao Paulo. So, over the stretch of the world, the reactions are slightly different. and the needs are slightly different. But one thing that we will come back to, and where Walid will definitely add, is the one consistent themes. The consistent themes are around how do we get this data? How do we manage this data? And how do we limit the exposure of the group to distributing that information around the globe as well? So there's an awful lot of stuff, not just around will I end up paying more tax, but how do I comply and how do I limit the cost and depth of that compliance?
Yeah,
they're really important factors.
Yeah, and it's really interesting when you think about all these things and you're saying, oh, they're jumping in and you have the complexity of tax. And it's important to note this is all based off of book, right? And as we all know, book is really an interesting concept. People can take differing views, so you can have similarly situated taxpayers taking differing views on how things apply. And then you say, okay, well, what are some of the adjustments that you then have to make with regards to saying, okay, well, on this tax, we're not giving you credit for these reorganizations. We're not giving you credit for this. And so even when you have the most sophisticated taxpayers that say, I understand what needs to be done, right? I fully appreciate exactly what needs to be done. There's the complexity, and as we said, getting the data to say, I now back this out for this purpose, but not for this purpose, and carrying it through on so many different places, it becomes a great lift. And so I look forward to hearing, Walid tell us more about the data side. Being mindful of everyone's time, we talked about, things have sort of been moving at a progressive pace. For the past 2 years, we've seen further tweaks and so forth. At a high level, what should we know about the past 2 years?
Well, I think this slide that people can see now sort of just maps out how the very broad structure of this rule works. It has been prepared to a certain extent to map domestic US rules so that people can sort of understand and conceptualize. It's not that different. And that slide speaks for itself. The bit that's not on that slide is, well, why didn't the world just adopt the US tax code? Why is it not the other way around, right? Why does the world not adopt the And the answer is that I don't think people are really prepared for that complexity. So Pillar 2 is meant to be actually more simple. It's meant to be, as you say, consistent with qualified accounting statements. That might not be a concept as familiar at entity level to US, but it is to the rest of the world. And it also aims to strike out quite a lot of those domestic, should we say, reliefs, wrinkles, exemptions that exist within domestic tax codes. Now, nobody has got something as complicated in their own home tax code as the US has got. So in a way, you can see the fit and feel is a slightly different one for the rest of the world. But when you hear OECD talking, I mean, they would say, well, if Pillar 2 comes in, we might not need the anti-hybrid rules anymore because we're cutting through all that stuff. We might not need the tax-free reorg rules anymore because we're overlaying that with Pillar 2. We're bringing a conformity and a consistency based on a solid set of data that is different to the way that we've taxed multinationals before. So there is a difference in the way it may develop. And certainly, as Nick said, in the European Union, you can project forward to the day where Pillar 2 becomes the basis for a single combined European Union tax return. And there are breadcrumbs already there in the Pillar 2 rules, and there's announcements within the European directive environment that you can see all the consultation happening on that already. So I think there's some of the differences as to why the world didn't adopt US tax rules. But it does strike you as, well, why didn't we just do that?
It's a shame, Neil. It's a shame. We would have been good in the US. But it is sort of interesting, and it's really important exactly what you just said, which is you start thinking about, okay, well, why don't we just eliminate the tax in general and just adopt this? And you start seeing the breadcrumbs of preference items and so forth. And it's really important to think about that. And we've seen that, at least in the US, with regards to, the comment period ended earlier this week for the new, corporate alternative minimum tax. And there's been a lot of pushback of, well, what about tax-free reorganizations? What about income that's normally tax exempt? There's a reason why Congress said that this should be excluded. Why are we subjecting it to tax? Well, now if you come in with Pillar 2, it blows up all of those tax preference items, because it's now saying, guess what? We're just saying you're subject to tax. It's much closer. I won't say it is, but it's much closer to a flat tax, where we're sort of saying we're trying to eliminate a lot of different preference items and just subjecting it, to tax and go from there, which
Yep.
obviously upsets the apple cart.
There's definitely a political environment. We could spend all day talking, but I think also the really interesting bits here are how do we deal with this, and we get onto the data side of things.
Yeah. So one of the things that we've talked about, this QDMTT, or the qualified domestic minimum top-up tax. The slide highlights some of the complexities, and as you can see, once you look at that middle concept, it's sort of like it allows variations. And once you have variations, this is where I'm saying, here you go. So Nick, what should I know about QDMTTs, and where do I go from here?
Yeah, I think for the people listening in, I think it's best explained through an example. So let's say a US multinational and you have presence in Ireland. Corporate income tax rate is 12.5% in Ireland. So let's say you have your presence there, you do your ETR calculations, and you end up with 12.5%. That is, of course, 2.5% below the Pillar 2 rate, which is 15%. So you need to pay a top-up tax of 2.5% over whatever your globe taxable base is for Ireland. So as Neil mentioned earlier, the way the rules work, the income inclusion rule and the undertaxed profits rule, that top-up tax could actually be levied somewhere else in the group in another jurisdiction. And what the qualified domestic minimum top-up tax does, it's basically a sort of optional facility included in the rules. It says, well, if Ireland wants to levy that 2.5% itself, then it can. And then it has to implement its own minimum top-up tax. But that only alleviates you from the standard Pillar 2 rules. So you no longer have to pay that 2.5% under the standard rules if that minimum top-up tax in Ireland meets certain criteria. And that's what we show here on the screen. And to keep it very short, basically the minimum top-up tax that you apply domestically has to be in line with the standard Pillar 2 rules. And then they make this comment, they say, well, or if it leads to a higher tax liability, that's also fine. Couple of variations in there, so you can use local GAAP instead of whatever your ultimate parent entity uses. So like small variations in there, but if you look at it from a broader perspective, it's not really going to change your compliance burden. You're still going to be doing pretty much the same calculations, but then to meet this domestic tax. But it is, I think, it's an important development, because we do expect that all countries are going to be wanting to levy any top-up tax themselves. So that's basically in a nutshell, that's how the QDMTT works. And I think, the big takeaway for US multinationals is, and we'll get to that a little bit later, is, with GILTI being a blended CFC regime, under the standard rules, you can push that tax down, but under the QDMTT, you don't. So you end up in a strange situation where your top-up tax in Ireland could actually be higher than if you were just to apply the standard rule set.
So with that, we're going to launch the next polling question. And again, please be sure you answer the polling question in order to get credit for CPE. Do you have access to the required data to compute the top-up tax under the standard globe rules? Yes or no? It should be launching on your screens. With that, while the poll is still open, we're going to start talking about the qualified blended CFC regime, and this is something that Nick highlighted. We'll start by just sort of highlighting, obviously, as this is focusing on U.S. panels, the late breaking news in the U.S. right, as the OECD said, congratulations, GILTI is now going to be viewed as a blended CFC regime. This was a big victory for the United States, as many countries initially suggested that GILTI should not be considered. And the reason for that is because a blended CFC regime is you get to use your income and losses from various jurisdictions to offset each other, and now you have this one number that's subject to tax. And so as a result of that, it would be possible that you can have GILTI income paying tax on it, and then as a result of that, you don't get to push it down to a jurisdiction that has adopted Pillar 2, and you still need to pay that tax. Great. Or not so great, in the sense of, I understand that I'm now paying even more tax, and it's sort of a double layer of tax. And you know, I'm sure we're about to talk about woe is me, because as Nick said, you get to take it into account only after applying, you know, the QDMTT. So if they have a top-up tax, then you don't get to factor in this qualified blended CFC regime. So you're still possibly paying for it twice. Now, with that said, the recent OECD guidance was exceptionally favorable. And what they allowed them to do is to say, when you have this, you actually get to allocate the tax associated with your blended CFC regime based off of, in essence, to fill the holes. So I get to actually say, oh, well, this is the jurisdiction with the lowest tax, effective tax rate. Let's allocate most of my tax there. So therefore, it's designed to sort of minimize the bite that Pillar 2 has. But it's really, again, because it doesn't jump to the head of the line, it's not necessarily, you know, the most effective system that prevents taxpayers from taking, you know, having to pay it twice. I guess I'll turn to my European colleagues. What else should we know about this blended CFC regime?
Well, I think you covered it there, Kevin. I mean, it's not really there isn't really a double taxation element directly towards it, but I think many people, when they do the maths, will probably think of it in those terms, that if there's something that's being picked up through one set of system of taxation and then there's another set of taxation, then to the extent that the credits don't mesh, or they're diverted. And by the way, there's a whole host of other rules in how QDMTT can be allocated within a jurisdiction, particularly in circumstances where it's not a 100% ownership chain. Then you can still end up with a whole mishmash of different credits and offsets and things. And this is where we get into this calculation really starts to get quite detailed if people want to start putting in totally different scenarios. So, I mean, it's there to read. You only really make sense of that when you start putting some numbers together. Otherwise, it's a brain ache.
Yeah, I mean, at the very least, you know, from when looking at the U.S., it was a very, at least from my perspective, a big political victory, right? That they said, you know, we get to now count GILTI, because before it was unknown, and it was like, okay, U.S. taxpayers were like, okay, here you go. And it wasn't a matter of, oh, you're only a blended CFC tax if you actually netted these things. It's like, because you have the ability to net, you're now a blended CFC tax, and so congratulations. So even if I only had CFCs that had income, I still was under this regime because I had the ability of netting. And so you can see why there was many US multinationals that were saying, okay, but all my CFCs are profitable. Why should I be concerned? And so this was a huge political victory. I don't know how much political capital was spent on the OECD to get them to say this. Now, with that said, it's noteworthy, right, that several of the key players at the OECD are now US-based professionals, so maybe that's helping move the needle. US Treasury has always taken this view that, oh no, the US is going to get credit for these taxes, and so it looks like, oh well, we've been telling you, so now it's like, haha, see, we told you. But nonetheless, it's not a perfect system, and there's still a lot.
Yeah.
You know.
Well, we'll see. I mean, I'm mindful of time there, Kevin. I don't know what the next slide is. I can't remember, but it feels like a good time to switch into the practicalities around the numbers and introduce Walid, because it is all about the data.
Agreed. And just to say it as an intro, the last polling question is, do you have access to the required data? 68% of our participants said no. So there's an acknowledgement right there that it's really one of those things that people don't have their hands around what actually needs to be done and the challenges that they're facing.
Those challenges are multifaceted and can be limited. There are some good things here almost and being proposed around safe harbors, a topic we'll come back to. But Walid, do you want to talk us through some of your personal experience?
Thank you. So yeah, having access to the right data is really tough. So if we move on to the next slide, I can show you through some of the computational steps that are required to move from your financial account towards your actual top-up tax in the end. And so is it possible to move to the next slide, please?
Yep, I need to jump, so I apologize.
Perfect, thank you. So basically, as you can see, the computation can be quite complex, and you need at the same time to have a good handle on your corporate structure, basically have every single ownership interest between each of the members of your multinational group, with both ownership interests and controlling interests. And this is already something about which some of our clients struggle. They have difficulties having this data in an accurate manner. And on the other side, you need to have your financial data at the right level of segmentation, meaning that you need to have all your legal entities, you need to have all your permanent establishments, and you need to have all your data divided between all of these components. And this is already a step for which a lot of companies struggle. And it is also necessary to have that for a lot of tax issues like transfer pricing and so on. But already this is something difficult. And the main issue is that the financial reporting systems of most multinational corporations has been structured not to be compatible with tax systems, local tax compliance, but has been constructed in order to build the financial report, the annual report. And so it has not been designed for this purpose. And so the reconciliation between that is one of the key difficulties. Once you have this data, there is a lot of work to be done in order to understand which element goes into what adjustment. So here you need to have access to the right advice, to the right knowledge in order to understand in your chart of account which element corresponds to what. Do you have the right elements? Do you need to split some accounts and so on? And once you have all the data, then the actual set of computations, well, it's another level of complexity. Instead of just having to just aggregate data, do sums and multiplications, well, you need to have some understanding of, well, graph theory, graph transversal, in order to actually compute what will be the task baskets to be to compute your ETR, and to identify the entities that will end up paying the top-up tax if you have any top-up tax to pay. So with that regard, the complexity is really hard, both on the data retrieval side, but also in the actual algorithmic computation necessary to fill in the globe information return in the end.
So Walid, can I just back up slightly and just go to your key step one?
Yeah.
So before you even get to a number, you've got scope analysis out there, and then you've got a box there with a couple of what you call subparameters. So JVs, MOMEs, IVs. I mean, just any examples you've got around what that means in terms of how you approach. What does a JV make? Why do you need to know if there's a JV, for instance?
So basically, when you try to derive the computation for Pillar 2, you start with your entire consolidated parameter. And then you will create some changes in the scope by excluding some entities. We will not go into too much detail, but if you have more specific questions, I'm sure Neil, Nick, or even I can answer these questions later. But the idea is that you will have to transform your perimeter, exclude some entities, reincorporate some entities that were usually excluded, and then you will have to segment this perimeter between entities that are consolidated with the equity method, and the entities that are consolidated either proportionally or fully. And this is already something that is complex because it questions the way your corporation is actually consolidating in their accounts. And next to that, you have all the types of entities that need to be taken into account differently, like the subgroups that you may own with an ownership interest at less than 30%, and also all the investment vehicles that you may own. And all these specific subgroups that we talked about, in each jurisdiction, they will constitute independent ETR baskets. So tax baskets where you're going to compute your ETR, and you will derive top-up tax for each of these tax baskets independently.
So that's a challenge there. Well, to get hold of, that's quite a challenge. Then you're telling people that if there's JVs in your structure, you're going to treat that JV differently, and you're going to have to obtain information that may not be the kind of information that you obtain in respect of that for your consolidation today.
And the worst case scenario is that for all the JVs that you have in your group, you don't collect the information in a coherent and consistent way between all of them. So these are the type of worst case scenario that we've seen. And so there is a lot of data cleaning that comes ahead of the Pillar 2 process.
And it's also important to stress, right, as Walid said, it's not a matter of not only getting the data, but also you might be treating it totally different than how you are for financial statement purposes. And so what happens when you think about that is when you're preparing for this tax side, you have to start becoming a financial statement expert, right? You start looking at, do I have these consolidated entries? Do I back out the consolidated entry? What are the adjustments that we need to make? And it becomes rather complex. And at least in the US, right, one of the big complaints that people have with regards to the alternative minimum tax, because obviously that's what we're dealing with now, is we're having to learn this. Everyone is like, oh, I'm just a tax person. And yeah, there's something called tax accounting, but that's normally tax accounting methods or something of that nature. It's not, okay, well, I need to now actually know GAAP, or I need to know IFRS, and I need to appreciate how these transactions interplay. And, you know, we're dealing with things like purchase accounting and should you or shouldn't you get basis step-ups. And, you know, there's all these things that are going to have to be examined and understood when you start thinking about the data that Walid was mentioning here.
Yeah, and then there's other overlays because everybody's domestic tax rules have not gone away. And so even in terms of the legal scope processing, there are these definitions and new definitions around Pillar 2, but you've still got, say, tax consolidations. And Pillar 2 is designed around calculating everything on an entity-by-entity basis, but in certain countries, everything is done as if there's one single tax unity with one taxpayer. And Pillar 2, I don't think right now really suits that kind of dynamic. It's sort of assuming everybody's every entity or legal entity or construct is a sort of separate reporting unit and a separate tax base. So there's a lot of work to do, not only in defining where you are from a Pillar 2 landscape, but you have to overlay all the gloss of the real world of tax, domestic transaction, domestic structures as well. So not to worry many people, but there's quite a lot of sort of three-dimensional chess going on in terms of even that legal scope processing box. It's helpful to try and limit that.
One aspect that has not been mentioned. One aspect that has not been mentioned is that there are a lot of what are called elections that you can make So basically, reporting choices that you can take with regards to the different aspects that we talked about. And so based on these elections, your actual top-up tax outcome can vary a lot. Either you pick the elections that facilitate your compliance, or you are able to go as far as picking the elections that will be the most efficient with regard to your top-up tax liability.
Well, why don't we go on to that? Because probably the single most immediate thinking around elections is the safe harbor election.
So there was an intermediary slide here about how to process the data. So basically, the most important thing is that you need to be able to collect all this data from your financial reporting system and also mix it up with the legal structure. And you also need to ensure that the entities that are not in your consolidated data can be added, and you need to be able also to perform the segmentations that you do not have in your system. So splitting, for example, an entity between itself and its permanent establishments. And so you need to be able to implement a system that feeds on your consolidation tool and allows you to create this super information. So these are really the most complex aspects about it.
Yeah, so we've talked about this. Now, hopefully we haven't scared you. Before, people said they didn't think they had access, and hopefully you'll be able to gain the access you need. But even if you think you're going to be able to gain the access, how confident do you feel you'll be able to actually obtain that data? It's a simple yes or no question. You know, while they're answering that, we've talked about the safe harbors, and this is on slide 15 when the comes back on. I guess while they're looking at this, Neil, do you want to sort of just give a highlight of the safe harbors, and then we can talk about how that impacts the data?
Yeah, I mean, I can definitely start that piece. So standing back again a little bit is that the safe harbor that has been proposed so far and has been elaborated in the guidance is this CBCR safe harbor, which is very much around trying to simplify the process of calculating whether a top-up tax is likely to be due, and then limiting the amount of compliance and filing in a particular jurisdiction. So it's very much jurisdictionally based. It's a risk assessment, and it's intended to smooth the compliance path. And Walid would be able to speak more succinctly about the amount of where the data comes from, because the data is slightly different to the data from the main globe rules. Before we do that, I just flag though that those going back even 2 years, there was a lot of, and there will be still more momentum around expanding the type of safe harbors. So one of the ones that was suggested was a sort of administrative guidance around safe harbors, which might be described as a whitelist. So if a particular country has been peer reviewed, it's got a safety net that it applies a tax regime which is very unlikely for anybody to be under the 15%, then from an administrative perspective, you could tick that, and then there would be no further compliance required. So that would be a big, broader tax administration led initiative.
Yeah, I think if
there's also a middle ground of the QMDT, which could be calculated, and then that could be given a sort of basis of calculation using a simplified method of calculating, probably using the qualified statements of the ultimate parent entity. So just one set of data works, nothing being produced at the local level. And then we've got the one that we've got in our hands at the moment, which has 3 legs, and maybe over to Walid to talk us, or to Nick to talk us through what that safe harbor looks like.
Yeah, I'm happy to talk through. Yeah, I think the only thing I wanted to add to your piece, Neil, is that yeah, we've got all these other safe harbors coming up, but the framework that you see here on the screen with these 3 tests, I think that one might also be converted into a permanent safe harbor somewhere in the future, so roughly based on the same principles as you see here. Yeah, you know, just for everyone watching, everyone listening in, 3 tests based. They call it the country by country report safe harbor. So I think that's your primary source of data. Yeah, so the first one is the de minimis test, basically saying, you know, if you're in a jurisdiction and your revenue is below 10 million and your profit before tax below 1 million, then it's just so small, we're not going to worry about it. You're excluded for that jurisdiction. You got the simplified ETR test, which basically says, okay, you can calculate your ETR based on your country by country report and the income tax expense in your financial statements. If you have 15% in 2024, 16, 17 in 25, 26, then you're also excluded. And then we've got the third one, which is the routine profits tax. That one, a bit technical, but basically saying, okay, if you have low margin activities in a certain jurisdiction, then we're not that worried about profit shifting. So you also get excluded. Yeah, tests sound pretty straightforward, but there's still.
I still want to add some specific point about that. So even if you're able to exclude a given jurisdiction from the top-up tax, if you have an intermediate parent entity and this jurisdiction that does not have to pay top-up tax itself, even if it's because of the safe harbor, it may hold shares in another entity that is located in a jurisdiction that is not protected by safe harbor and have to pay top-up tax because of that. So in terms of data gathering, with regard to the financial data set, yes, if you are under safe harbor for these entities in this jurisdiction, you do not have to have more detail than what is in the CBCR. However, with regard to the corporate legal structure, because of the charging mechanisms and the determination of who is going to have to pay, you still have to be able to locate the right elements of the shareholding structure to identify the right paying entities.
And I think another interesting point, especially for U.S. multinationals, of course, is again around CFC taxes. If you're applying this simplified or this transitional safe harbor, those taxes typically don't get pushed down in your country by country report. So same problem.
We have about 4 minutes left of the substantive before Kevin DeYoung shows us CCH Answer Connect. So I thought I would give this opportunity for the 3 of you to sort of share what insights they should know as far as what should U.S. multinationals be doing now, what should they know about collection of data and thinking about Pillar 2. So with that, I guess, Walid, we're on sort of the last slide about your safe harbor rules, but from a data collection process and thinking about U.S. multinationals and other taxpayers, I'll first turn to you and see what thoughts you have to close it out.
Well, thank you. So from our perspective, the first thing to do is to try and test the data that you already have. Do you have a legal structure management system? Are you able to export the data and run some algorithms on them to verify who would be paying entities and what would be the tax baskets in each jurisdiction? Do you have CBCR data? Do you have this CBCR data at entity level? If you have that, it's easy to do some, if you want quick and fast, quick and dirty computation for your top-up tax liability, and using the corporate structure, try and understand your top-up tax liability before going into a lot more detail. And you will also at this stage be able to know for which jurisdictions you don't need to make all the efforts with regard to the details in your financial data. So this is really what I want to stress. You have some time to do this stress tests before the actual implementation in the jurisdictions that are moving forward.
That's very helpful. So with 2 minutes left, Neil, Nick, what are your thoughts?
Yeah, I mean, pretty much aligned with Walid. I think, at this stage, 1st of January 2024 is approaching rapidly. Then you got 18 months to file your first globe income or information return. So, you really need to start thinking about, do I have a good view on which entities in my structure are in scope, considering all those specific rules that we discussed. And then also, seeing, can I apply for safe harbors or not? And, once you've got a clear view on that, which also requires a little bit of data, then you can really move towards a sort of tailored implementation plan for the coming year and a half.
Super. And well, Kevin, we've talked a lot from a very much a corporate perspective, and that's entirely appropriate. That's the main compass of Pillar 2. I do a lot of M&A work. I do a lot of work of M&A with investment funds, sovereign wealth funds. So again, it's a similar discipline, a similar protocol, but they need to think about, are they in the consolidation rules? Are they in the deemed consolidation rules? So they begin to take a more corporate solution from a Pillar 2 lens than they're used to. Have they got hybrids in their structures, very often being used above wherever a fund manager might be? So that there's a whole universe of different exemptions, but different applications to different people. So it's not for today, but I would say that it does bring in a degree of sophistication from a completely different data set than has been used to produce K1s and things like that. So I just don't want anyone to take away that just because you're not a multinational corporation, Pillar 2 doesn't come potentially to your door. So again, anyone who's got questions on these things, they can turn to advisors or others for assistance.
And to that, our contact information is in the back of the slide deck. Feel free to reach out to us. I want to personally thank Walid, Nick, and Neil for joining me on this virtual coffee talk. I'm going to turn it over to Kevin DeYoung to show us what we can see and learn from CCH Answer Connect.
Excellent. Thank you, gentlemen. Great information packed into 52 minutes. Pretty impressive. Margaret, would you mind passing over screen share control to me?
Yes, just one second.
Well, as the screen share is being passed over to me, I think what I really want to do here is give you a high level look at many of the concepts that were discussed during the presentation, some of the OECD content information that's available out there. It seems like there's an issue regarding having this information available or readily available to each of you on the call. So what I really want to spend some time doing, as opposed to going into a deep dive of all the functionality and how we move around within the systems, workflow enhancements that we've done with our CCH Answer Connect platform, really want to focus on that content set as it relates to the Pillar 2. Thought that'd be a great use of our last couple of minutes here. So within CCH Answer Connect, I'm simply going to go in and start by doing a keyword search on Pillar. And we're going to start going into the content set that we've put together for you as it relates to this very, very hot topic and the evolution of what this is going to look like over the coming months and years as more and more countries take a look at this and start to implement many of these suggestions through the OECD. The very first hit here is my topic page related to the BEPS profit sharing in Pillar 1 and Pillar 2. What we're looking at here within CCH Answer Connect is the holistic view. What is the overall concept of Pillar 1 and Pillar 2 so that you can build that foundation, that understanding specifically of the issue that you're now being forced to look at and address globally. So as I scroll down, I'm going to take you a look. You'll notice we have a lot of the information highlighted in blue here. What's really important about this, these are going to be links to additional content sets that we've made available. Some of it will be briefings that our editorial team has put together. Many of it will also, though, be links out to the specific OEC documents. So you have access to all that information. Pillar 1, as I scroll down, we talked a lot about Pillar 2 here. I want to pause quickly regarding this reference section. And again, the link to all of that information, the Pillar 2, some of the guidance that we put together that came out in December of 21, the administrative guidance. I heard that there was questions regarding access to that globe content. Do you feel comfortable having it? Do you have access to that information? That's also now available directly through CCH Answer Connect. You can have that content specifically there for you. You'll see our editorial team will model a lot of what you heard in this conversation regarding a 5-step approach, regarding how to deal with Pillar 2. We then walk you through that step by step as well. So we've talked about the very high level overview of the conceptual piece. I'm going to go back to my search results. And we're going to actually do a little bit of filtering here and go back into a specific jurisdiction. In this case, I'm going to open up my jurisdictional filters. we're going to scroll down to to Singapore. Since it is known that Singapore has actually released positions on this, a statement on what's going on here. So I'm going to go directly into my Singapore content. You'll notice we've now filtered down. So I'm looking at a specific country. I'm again going to open that topic page. And now, as opposed to dealing this holistically, we are now beginning to see the guidance that can come out from these countries and where they stand on this, what position they're taking. Again, you have that information available to you. From here, we also have, from a workflow standpoint, we have news. There are going to be many, many more countries that are going to be issuing guidance here. This is where the news feature within our international content, we will be feeding this to you as it is released by the specific jurisdictions. We also have the ability to go into smart chart technology, where I can go into the BEPS country tracking, specifically taking a look at action plan number 1. I can then go into my jurisdiction. Here I'm going to pick on Singapore yet one more time, so we can specifically see how the smart chart technology will also walk you through directly, in this case, what Singapore has done in February 2023. They've issued some guidance, an announcement regarding their position on this. And as more and more countries do this, we will continue to update this smart chart to give you access to that content. Going to go back to my CCH Answer Connect, to my search results, and just want to show you a couple of additional tools that are out there to help you address this specific area. As it relates to emerging issues, hot topics, I'm on my international tab within CCH Answer Connect, and you can see there is a tremendous amount of focus on the Pillar 2 tax plan. The budgets that have come out here, here's Singapore specifically dealing with that as it relates to Pillar 2. So again, just a host of information available to you at your fingertips. So wanted to point that out. One last item, because we did hear some discussion regarding the corporate AMT here within the US. Again, another very complex issue that we want to give you guidance on. From our emerging issues and tax reform, we have a decision tool that will again walk you through that. I've already opened it up here. So it actually talks you through what some of the rules are, some of the specific items you need to know. Again, all of these blue hyperlinks will take you to primary source documents, but this decision tool allows you to go through a set of questions and answers that will streamline the content to the right, driving you to a content set to address the issue you're dealing with as it relates to the specific client or entity type you're talking about. So again, just another tool out there to allow you to maneuver and get an understanding of this very complex issue as we're all dealing with this globally. So with that, again, thank you for your time. We'd love the opportunity to talk further with you about CCH Answer Connect and the resources we have available. I am going to pass it back over to Margaret now, who will give us our final polling question. And again, thank you very much for your time.
Thank you all. That wraps up today's webinar. I want to thank everyone for their participation. CPE credit will be posted within 2 to 4 business days. You will receive an email with a link to the course evaluation and your certificate of completion. Today's webinar has also been recorded, so you will receive an email with access to the link of the recording. Thank you for attending and have a great day.